E is for expense ratio. How are you guys doing today? My name is Apple, and today we are filling in the financial gap between schools and the real world. And today we are at it with our 5th installment of our financial literacy A to Z series, which, as you'll remember, is linking our YouTube channel to my newly launched website, applecrider.com. So this video is going to be accompanied by a corresponding blog post that is going to take the information that you learned in this video a step further and show you how to actually start applying that in your own life. So be sure to head over to that blog post. Link will be in the description to see how to start applying these principles to your own life as a young person, as a college student. So in this video, it's just gonna be a broad overview, sort of a what is it, why is it important, of, in this case, expense ratios. So that is what we're gonna be talking about today. Before we hop in, do leave a like, subscribe, share this video with a friend, and let's do it. Okay, so what is an expense ratio? At its most basic, an expense ratio is simply the fees that you pay on your investments. More specifically, the fees that you pay on any funds that you invest in. So let's break this down. If you're confused, if you're like, what is a fund? What does that mean? Okay, a fund. So with funds, you've got two options. You've got your mutual funds, you've got your index funds. Let's start with mutual funds. So mutual funds are a clump of investments, stocks, bonds, and cash, okay? So you've got a clump of stocks, some bonds, some cash, all put together, and there is a professional asset manager. This is a professionally managed fund. So there's a professional asset manager who is deciding which stocks to buy, which bonds to buy, how much cash to hold, all of that good stuff. And you are buying a little sliver of this clump of stocks, bonds, cash. That's called a mutual fund. You buy this clump, that is yours, and you are relying on this professional asset manager to dictate where your investments go. Now, an index fund, on the other hand, that is a passively managed investment. What that means is there is no asset manager deciding what to buy, what to sell, all that good stuff. This index fund just aims to track an index. So in this case, an index would be the S&P 500. So that is just 500 of the biggest publicly traded companies in the United States. An index fund would just track that and attempt to mirror that, so you don't need somebody on the other end to monitor that very closely. They just sort of buy the things that make up that index so that it tracks that index very well. So an expense ratio is what you are paying the person to either design this index fund or to manage this mutual fund. So with your index fund, you don't need a full team managing it. You just have maybe a couple people who set it up, and there's not a lot of maintenance that has to be done. Maybe they rebalance it every year, every quarter, but there's not a lot of maintenance. Whereas with that mutual fund, you've got a whole team of investors deciding what to buy, what to sell at all times. So they are going to need to be getting paid somehow, and they are getting paid through that expense ratio. So your expense ratio is a percentage that is going to come off the top of any returns that you make from your fund. All right, so let's say you had a 10% return on a mutual fund. You had a 10% return, but there was a 2% expense ratio with that mutual fund, which you can find on any fund. It's going to show you, it's one of the main things that it'll show you on like an overview page of that fund. It's going to show you the expense ratio as a percentage. So it's going to have a 2% expense ratio. So simply what you're going to do is you're going to minus that 2%, and you are left with an 8% return. That is the money that you see. So your assets, your stocks, bonds, cash went up in value 10%. Your expense ratio was 2%. So what you see as the investor is you see an 8% return on your investment, even though the assets that you were invested in went up 10%. All right, but what if, say, your investments just broke even? So if your investments just held value throughout the year, what would your expense ratio do to your returns? Well, if you had a 0% return and you still had that 2% expense ratio, the managers are still getting paid even if they just hold your money's value, and in the end you end up actually losing 2% if your assets just hold their value over time. So expense ratios are very significant, and even if they don't get you even if these managers don't give you a return on that investment, you're still going to be paying them. So that is something that you really need to keep in mind. All right, now let's look at more of a real world example. Okay, so say you invested $10,000. Say you had $10,000 to invest in a mutual fund that had a 2% expense ratio. You would think, all right, 2% of $10,000, $200. That is what you're going to be paying this asset manager to manage your funds. Well, let's see if that is actually the case. So say you invest in this mutual fund with your $10,000, say you put it in there for 50 years and you want to come back 50 years later, see how much money you have. And we're going to say this just tracks the stock market as a whole, which on average performs about 10% a year. So we're going to use that number, 10% a year, for 50 years you are invested. All right, so your 10%, your $10,000 at 10% over 10 years, what's that going to be worth? That's going to be worth $1.174 million. So you now have over $1 million that you just made from that $10,000 investment over 50 years. So that's great. Say you invest now when you're 20, you put $10,000 away, you come back when you are 70 and you now have over $1 million. Fantastic. But what about that expense ratio? What about that money that you are paying that asset manager, that 2% that you are paying to your mutual fund? What does that look like now, 50 years later? Well, the money that you actually see because of that expense ratio, you actually only see $469,000. So that is a difference of $705,000, guys. So look at this difference. All right, so your money brought a return of over $1 million. However, you only see $469,000. This $705,000 is going straight into the pockets of that asset manager, guys. This is very significant. So as you can see, a 2% expense ratio over 50 years, that is a big difference. You are seeing less than half of your money. I mean, practically 2/3 of your money is going towards this 2% expense ratio. So you really got to keep these in mind when you're investing. I think this should be a very big, like, whoa to you guys. I mean, it was to me when I first realized how significant expense ratios were. This was like a big deal. But this expense ratio only applies to funds. So say you bought shares of Google or Facebook or Amazon or whatever. There's no expense ratio to that. There might be some commissions to buy the stock. I personally use Robinhood, which doesn't have commissions at all. But if you're using a stockbroker with commissions, there might be some of those. That's just a one-time fee when you buy, a one-time fee when you sell. But expense ratios are going to be throughout the life of that investment. And expense ratios are only for funds, only for mutual funds, index funds, stuff like that, not for individual stocks or bonds. And with your funds, it's not actually just the expense ratio. It doesn't stop there. There are actually more fees that go along with your investment than just the expense ratio. So besides the expense ratio, you've got two main things. You've got your annual fees and you've got your loads. So annual fees, that's just gonna be something like, all right, if you're invested in this fund, it's gonna be a $100 annual fee that we're gonna charge you. So that's easy enough. That's easy enough to plan for. You know about that. What about loads? So loads are transaction costs. So sort of like those commissions I was talking about for individual stocks, loads are sort of like the commissions of funds. So with loads, you can either have a front-end load, a back-end load, both or none. So for front-end load, they might say have a 4% front-end load. So if you wanted to invest that $10,000, they would take 4% off it right away. That's $400 right to them, and you only invest $9,600 in this fund. A back-end load, same kind of deal. If you end your investment with $10,000 in there, you want to take it out, and they have like a 4% back-end load, that's $400 right off, and now you withdraw $9,600. And then there are some no-load funds, which are really nice. If you say you are a Fidelity customer, you have like a Fidelity Roth IRA, and you want to invest in some Fidelity funds, a lot of times they're going to waive these loads, and they're going to offer you no-load funds. Same goes for like Vanguard. If you're a Vanguard customer buying Vanguard funds, they might allow you to get those at a no-load fund. So those are the basic fees that you're going to be running into with your investing in index funds or mutual funds. Now, why is this important? Why are expense ratios and fees something you should know about as a young person, as a college student, as a young investor? Well, you gotta know your numbers with any investment you go into, whether that be stocks, bonds, real estate, Bitcoin, whatever. Any investment you go into, you gotta know your numbers. That's the first thing. Before you put a single cent into any investment, you gotta know the numbers. So a 12% return is not a 12% return. As you can see, as you saw by our example, a 10% return is not a 10% return at all, because these expense ratios, they really do add up over time and eat into your profits. So if there's an index fund offers you, or that has historically returned 12%, and a mutual fund that's historically returned 12%, mutual funds, again, tend to have those larger expense ratios because they have that actively managed team, that The mutual fund is likely going to offer a much higher expense ratio to you than the index fund. So the index funds might be a much better investment because they have that 12% return with a much lower expense ratio than your mutual fund with a 12% return with a much higher expense ratio. Also, this is important because literally a 1% difference can be the difference of millions of dollars. Like you saw in this example, in our example, a 2% difference in expense ratio was literally $700,000 worth of difference coming from only a $10,000 investment. Like you never added to that investment, yet that 2% expense ratio ate up $700,000 of potential gains. And to see this for yourself, I would really recommend playing around with a compound interest calculator. If you literally just Google compound interest calculator, I'll link one in the description below as well. But just playing around with the compound interest calculator with different expense ratios, it's honestly, it blows your mind. I can spend hours just like messing around on a compound interest calculator. Probably that's just me, but I could spend hours doing that because it's so mind-blowing, like how much of a difference one small change could make. Fractions of a percent can make a massive difference in the span of, say, 20, 30, 40, 50 years. So what it comes down to for me is if you want broad market exposure, if you want to invest in a fund that's going to have all these different types of stocks, bonds, cash, whatever, all in that clump, if you want to invest in something like that, I would highly, highly recommend index funds over mutual funds, just because that expense ratio is going to be much, much lower and it's going to cost you a lot less to do so. That is personally where I invest. I invest in index funds. I do not invest in mutual funds at the moment. And that is mostly because I like to have more control over my investments and I don't want to be paying those crazy expense ratios. And honestly, index funds, they're usually cheaper. They usually have those lower expense ratios. And over time, they do tend to perform. And over time, they actually do outperform actively managed funds on average. I mean, obviously, there are going to be some underperforming index funds and some overperforming mutual funds, but on average, index funds actually do tend to come out on top because they have those lower expense ratios. And like I said, you gotta know what you're paying, you gotta know your numbers, and sort of what this feels like to me is like, would you invest in a house if you didn't know the mortgage payment up front? Would you go out and buy a house and just have no idea how much you're gonna have to pay for your mortgage every single month? No, you wouldn't. You wouldn't go into an investment like that without knowing how much your mortgage payment was gonna be. So why would you go into an investment like a fund without knowing how much your expenses are gonna be? That is what it feels like to me, and I feel like people just don't realize how much expense ratios actually do add up over time and how significant they can be in your investing. So know those numbers and be sure to check out that corresponding blog post, just link in the description below, on my website, applecrider.com, to see how to take this a step farther and start applying these things into your own life and your own investing. Anyways, thank you for sticking around. I will see you tomorrow. Leave a like, subscribe, share this video with a friend, and until next time.